back. You're watching In Focus. Now, Kenya has witnessed a housing boom in the recent years, a development attributed to rising incomes, a vibrant economy, diaspora remittances, and access to credit. But some analysts are characterizing the boom as a bubble headed for a major burst with serious consequences. One of the concerns is the up to 20% interest rates being charged on mortgage loans by Kenyan banks. In a recent interview with Kenyan US-based investment advisor Joseph Wambia, CEO and managing partner at Linkage Capital Partners, I asked him to first share with us what American banks are charging for mortgage loans.
3.5%. 30-year mortgage,
yes,
with a 20% down payment. And, you know, a poor credit is maybe 5.5. But actually, there's no credit available for people with bad credit in the U.S.
As an investment advisor, what would you like Kenyans to know about loans, interest rates, and the future of their properties, or some people may see it as of their investments?
You should go ahead and buy a house if you're going to live in it and you can afford the down payment and you can afford the mortgage. Because at that point you're making a value proposition. It's worth that much for you. You're going to save in rent, you will benefit from the appreciation, and you're going to enjoy the property with your family. So if you can do that and the bank is willing to lend you that money based on sound credit with 20–30% down payment, and you're not pledging family land or some other, sensitive property as collateral, then obviously you can afford it if it's not more than 20% of your income or your monthly takeaway, the service payment, the debt service. And there are people in Kenya who can afford that, quite increasingly more. However, you should not buy a house if you can't afford the down payment, and if you don't plan to live in it and you're trying to do it as speculation to maybe sell to another greater fool. Because what will tend to happen in that situation is you may not find a buyer, you may not find a tenant, and it will be foreclosed on you and it will impair your credit. Buyers need to understand, why is the developer so eager to offload so quickly if indeed they are sitting on such a valuable property? That should tell you something. And a lot of developers are in a frenzy to offload, which means the developers know that this boom is going to last for a particular period, and the faster they can offload, the better.
Something else I noticed is that there is a trend that I think is becoming more and more common, where real estate developers, have a piece of land, they kind of have a plan of units, and they tell you to put down a certain percentage of the total cost of that, and they construct this house, and at the end of construction, which is sometimes a year later or so, you're supposed to pay up the rest, and then they give you the keys.
Right.
Who is the winner here? Who is the loser? Who is the bigger fool?
The developer is always the winner. The retail buyer is playing the lottery. The developer is always the winner. The developer is typically able to walk away from the development as a bankruptcy event and still go away smiling at the bank, leaves the bank with the entire loan. And the bank forecloses by acquiring the useless piece of land and the half-built properties. If you're looking at something, very simply, what is this investment that can support an interest rate of 20–25%? You must be producing something that is earning at least 20+1% in real terms. Okay, a good business, risk-weighted business, as a return of 25%, that is called a very good business, a very good investment, a real company, a real economy. The economy of Kenya, which is a business, the business called the economy of Kenya, is growing at 4%. That is what the economy of Kenya is producing. That tells you the extent to which this is an anomaly. Now, 4% is an average. There are 9% sector growth, there are 12% sector growth, I'm not suggesting. But on average, and incomes are growing at 4%. GDP is a pretty good indicator of income growth. Now, if your income is growing at 4%, how can you afford an investment that charges you 20% per year? Something isn't adding up.
And also, when you look at everything altogether, from the cost of material, from the purchasing power.
Right.
You look at the price of those houses, and then the interest rates. Do you get the sense that they're overpriced, but people are not thinking that way?
People are not thinking that way. You know, I've talked to quite a number of these people. I talk to the developers. They come here selling to the diaspora, and they are always finding takers. By the way, incidentally, they are finding takers mostly, unfortunately, increasingly, among lower income diaspora people, which is very unfortunate. People are having a very hard time making ends meet here.
2 jobs, 3 jobs.
2 jobs.
Yeah.
Some of them are watchmen. Some of them are drivers. You know, truck drivers, taxi drivers. Some of them are really, really hard luck cases. And they somehow feel that because they haven't succeeded here in the US, somehow they'll be able to succeed back in Kenya. I usually point out to people that if you haven't succeeded in the US, your chances of succeeding in Kenya are very low, because the US is still a land where it is much easier to succeed than almost anywhere in the world. First succeed here. Now, as you may have heard me speak elsewhere before, I encourage people to have their personal house in Kenya because it increases their commitment to the country. I'm very passionate and very committed as a Kenyan to maintaining and investing in Kenya, and I have property in Kenya.
Well, that was Joseph Wambia, a native of Kenya and CEO and managing partner at Linkage Capital Partners.